Ladies and gentlemen, once again, please welcome Kurt Pfotenhauer.
I'm still getting used to the whole theme song thing. Thank you. Hey, welcome. Welcome again to the final day of our 2009 convention. Have you enjoyed the session so far? Wonderful. We don't wind down on Saturday until this evening, and then we kind of wind out. But today we've got another tremendous session in store for you. A couple important things. The speaker we have today is someone you saw last year at the convention, Fannie Mae Chief Economist Doug Duncan. And he is going to, he's one of the most accurate forecasters in the country, has frequently been recognized as such. His presence here today is sponsored by Chirs Abbinante Fidelity National Title. And I got to tell you, Chris is in this part of the session because he believes so much in TIPAC. And today's really a TIPAC day as well. TIPAC, the first $5,000 check we got this year was written by Chirs Abbinante. Came in right after the beginning of the year. Chris is from Chicago, okay? He's a big guy. And if he asks you for a contribution and you haven't contributed yet, I suggest that you quickly comply. In order to introduce you a little bit better to the concept of TIPAC, we're going to run a video, not yet, and we've been able to recruit a couple of folks who from Washington, D.C. know what they're talking about, some lawmakers, some political pundits, just to talk to you directly about the importance of our political action committee and what it enables us as an industry to articulate in our nation's capitals and in our state capitals around the country. We then have the all-important transfer of power. And we can giggle a little bit about that because it sounds like a very highfalutin that we have the official transfer of power. It's a peaceful transfer of power. But it's important because even in this group, you know, we're the title industry. There are profound disagreements. There's competition once we walk out on these walls. And it's hard to get agreement. And we work hard every day. And the board of directors of the American Land Title Association is the one that is charged with getting agreement in the industry so that we can have a voice, so that we're not many voices but one voice. And that takes a lot of intelligent, persistent shepherding of stakeholder interests to braid them together into a single position. Mike Pryor did that for the last year, and as I mentioned earlier, spent 86 days on the road for the American Land Title Association, and today he will pass the gavel to a new president, Mark Winter, who will take those duties on. Won't get paid a nickel for them. It'll cost him sleep, it'll cost him time, treasure, but he's here to do it willingly, in fact, eagerly. So, I'm going to leave the stage because the first part of this video that you're going to watch, I'm actually in it, and it's weird to stand up here with yourself going on in the background, but then Chris will come out and introduce Doug Duncan. I hope this is, we're a little smaller today than we were yesterday. There aren't people standing up, but for you who are here today, buckle up. This is going to be a terrific session. Thank you for being here.
Ladies and gentlemen, please welcome the president of Fidelity National Title Group, Chirs Abbinante.
Good morning. For those who don't know, John Vaso will be, there's only 3 exits here, by the way. John Vaso will be standing at this door with my Uncle Vito. He came down from Chicago. I brought 2 other friends that'll cover the other exits. Just in case, Joey Bag of Donuts is here, and Vito no-nos. So please, all kidding aside, it is important that we make our voice heard, and this is one way we have to do it. So I encourage all of you, if you haven't already done so, consider giving to TIPAC. It is truly, truly important in helping get our word out and get things accomplished that we need to do. I'm pleased to introduce this morning Fannie Mae's chief economist, Dr. Doug Duncan. He was named one of the top 100 most influential people in real estate by Inman News. As vice president and chief economist of Fannie Mae, he provides economic, housing, and mortgage market forecasts and analysis to millions of consumers around the globe. Dr. Duncan is an important source of information on the external business and economic environment. His commentary on legislative and regulatory proposals and industry trends is heavily relied upon by international industry professionals. We are privileged to have him here today. Please join me in welcoming Dr. Doug Duncan.
Good morning, and thank you for the invite. Is my tie straight? There was this big guy back here. Whew. He's very convincing. It's great to be back with you. As I was sitting back there, I was looking up at the ceiling, and I've always had an interest in housing. I grew up in a house in rural Minnesota where we didn't have plumbing until I was 9. So this is the other side of the housing spectrum. That's kind of what I was concluding from that. But it's great to be here. I was thrilled to have a chance to meet Hernando de Soto. He's a guy that has changed the world with some basic observations about economics. It was great fun. I was able to join Mark and Mike and their wives and Kurt for dinner with him. And it was really interesting listening to some of his things. On the way down, just by chance, I was reading. Any P.J. O'Rourke fans in here? Okay, P.J. O'Rourke on the Wealth of Nations. So 2 quick anecdotes about P.J. O'Rourke. First of all, about 12 years ago, I was at a conference, a mortgage bankers conference. I was sitting in the back of the room, and Ralph Kerrigan, who at that time was the servicing manager at SunTrust, was doing a panel, and he stopped in the middle of the panel and he said, "Wait a minute, that's a question on interest rates. Doug Duncan's sitting in the back of the room. Let me ask him." So I said, interest rates, that's the province of macroeconomists. I'm a microeconomist. I don't do that. Because at the time, I wasn't the chief economist at MBA. So that night, the Wall Street Journal went to print, and the next morning, in it, they had a review of P.J. O'Rourke's book, Eat the Rich. Anybody read Eat the Rich? It's a hilarious book. So in it, I brought the Wall Street Journal. I said, based on what happened yesterday, I need to read you a little bit of this book review. So in it, P.J. O'Rourke says, macroeconomists are people who are generally wrong about the economy. Microeconomists are people who are specifically wrong about the economy. So as I was reading this, this is basically the Cliff Notes. Anybody in here read The Wealth of Nations? Adam Smith. Can you cite the whole title of it? It's actually an inquiry into the nature and causes of the wealth of nations. So that's the actual whole title. But the other book you have to read with that is A Theory of Moral Sentiments, which is in which he lays the moral underpinnings of capitalism and free markets. And then The Wealth of Nations is a description of how the economics work. This is the Cliff Notes, and it's funny. As I was reading, I thought I would read you a quote on housing. This is what Adam Smith says about housing, because we're all about housing in this industry. This is how he introduces it. He says, this is O'Rourke speaking, hundreds of years before yuppies began installing pseudo-Palladian windows in the profusion of gables that blocked my view, Adam Smith warned against betting too much accumulation and employment of stock on a red-hot housing market. So this is Smith quoted. "A dwelling house, as such, contributes nothing to the revenue of its inhabitant. If it is to be let to a tenant for rent, as the house itself can produce nothing, the tenant must always pay the rent out of some other revenue. Though a house, therefore, may yield a revenue to its proprietor, it cannot yield any to the public, nor serve in the function of a capital And the revenue of the whole body of the people can never be in the smallest degree increased by it. So he was discussing the allocation of capital to housing, which is really a discussion that we have underway socially today in this country. And I phrased the critical question to me in sorting through what's going to happen in markets is, in the long run, what's the sustainable rate of home ownership? So we got to 69.2% as a home ownership rate in this country. We're now under 67% and falling. Why is that important? It has a lot to do with what Adam Smith said about houses. Because every 1% that percentage point that home ownership rate falls, 1.1 million households who were owners living in a house are not now owning that house. They're either renting or they've combined households with someone else, but we're not tearing the houses down. So we've already had 2.5 to 3 million people who owned a house temporarily and now don't, and we probably have another couple of million that will exit that house. That's underpinning all of the turmoil that we're seeing. Now, it plays out in lots of different areas, and the concept is not new, or the principle that's at work here is not new. It's leverage. In fact, a couple of months ago, I was asked to address the Federal Reserve Board, and so I took like 3 slides. The first one was a quote from the LA Times, and I'll paraphrase a little bit, but essentially it said, "We Californians have learned something. House prices can't go up forever. Ultimately, they have to be supported by something. We'll never make this mistake again." LA Times, 1886. Now, the reason I led off with that slide was I wanted to make a point to the Fed board that I don't believe we're going to fix all these problems today forever, because we've had this kind of a cyclical event combining real estate and financial institutions many times in our history. Can we improve things? I think we can. There are some things that will be done in the policy arena to make it better, but will it never happen again? I think that would be naive to believe that it will never happen again. So how do we prepare for that? How do we see the outworkings of this as we go forward? So I'll take you through sort of our view of where things are going. And feel free to lower the BS sign, or raise your hand, ask a question anywhere along the way. I get to hear myself speak a lot, and so I'd rather get to hear you speak. This basically says Fannie Mae will deny I was ever here. Disclaimers are really boring, so you got to find some way to jazz them up a little bit, All right, so what am I trying to tell you here with all of this noise? The 2 red bars are the critical issue. What I've done is I've gone back, and my staff has done it. Let me not take credit for the work of others. I said, let's look at all the first year of economic recovery after each recession since World War II, and let's see on average how big is the first year's growth and what contributes to it. And then let's compare our current forecast to that. That will maybe give people some comparatives to judge what they're likely to see coming ahead. So on the far left, the red bar says in the first year of expansion after a recession, averaged across all the post-World War II expansions, the economy grows about 6.5%. Now, the red bar in the center, that's our current forecast. We expect it's going to grow somewhere between 3 and 3.5%. So it's growth, but compared to historical averages, it's very moderate. So when we say weak growth, some people don't have that context of history. We've seen growth as big as 10% in some expansions, as small as, say, 2%. This is a relatively weak expansion that we expect. I'll take it apart and explain to you why that's the case. The other bars in there are what percentage of that growth is contributed by different areas. For example, consumer spending, which is always the largest. At the end of the recession, consumers start to recover some confidence and start increasing spendings. Second biggest contributor is the growth of inventories, rebuilding of inventories, because in the recession, companies are cutting inventories to cut costs. So then they start building up inventories as consumers start to spend. Third is housing. So housing, 18% of that first year's growth on average comes from housing. There's only been one recession post-World War II where housing did not make a positive contribution. That was 1980. And if you recall, that interest rates were somewhere in the 15 to 18% range. President Carter told people to stop borrowing money because it was causing inflation. That's not a really very good environment for housing if you can't borrow money and you have to pay 18% on what you do borrow. Not going to be good for housing. So housing contributed nothing in that expansion. But what happened was it generated pent-up demand so that after the 1982 recession was over, housing contributed a great deal to the expansion in the first year after that. So a question you have to ask is housing in a position to make a strong contribution to the growth of the economy as we come out of this recession? Our belief is there's still some problems. It will make some contribution. We think in terms of transactions, we've probably reached the bottom and might see a little bit of improvement, but there's still some significant troubles to be dealt with in the housing sector. Now, people are asking, well, what about all the money we're spending on stimulus? So what I've done here is I've divided between the tax aspects of the stimulus and the infrastructure spending. So two things to observe. One is that after about April of next year, all of the tax aspects will be in place. That will be done. Then the question is, will the infrastructure spending contribute to economic growth? Well, there's a pretty sketchy record of infrastructure spending as a stimulus. For example, take the Eisenhower administration. That's the period when we had the greatest amount of infrastructure spending relative to the total economy that we've ever had post-World War II, because we were building the interstate highway system. We had 2 recessions during that administration. So it's a little hard to say that infrastructure spending is stimulative. What it does do is it improves economic efficiency down the road. No one would argue that it wasn't a good investment to build the interstate highway system, but it wasn't necessarily stimulative in terms of near-term growth. So just a couple of historical facts there. Now, what I've done here is I've said, well, just exactly how bad is the employment situation relative to prior periods? Because obviously, people who have jobs buy houses. People who don't have jobs don't buy houses. Well, we tried that. Didn't work very well. So we've kind of gone back to that have a job, get a house kind of a theory. So what I've done here is I've looked at in percentage of jobs lost from the peak of employment. The reason I did it that way is because our workforce is a whole lot larger now than it was at the end of World War II. So if you look just at the number of jobs, that'll sort of distort your view. So what you see, the light blue line that goes furthest down and to the right, that's today's recession. So it tells you how many months we've been losing jobs and what percentage from the peak of employment we have fallen. So you see we've lost about 5% of the jobs that we had at the peak of employment, and it's been underway now for 19 months, and we think it'll be underway for at least another 4 months or so, possibly 5, peaking at about 10.1% unemployment in the first quarter of next year. Now the other one that was rougher, that dark blue line that goes down all the way to 5%, that was at the end of World War II. We had a recession coming out of the war. But you sort of have to recognize that we were shifting our whole economy from a war material production structure to a consumer economy, and there's a lot of dislocation in the labor market when you do that. So that one is an anomaly in that sense, quite different than the other recessions that we have. So looking at it that way, this is the roughest recession that we've had for employment post the Depression. But of course, during the Depression, we got unemployment up to 25%. So this is nothing close to what we saw in the Depression. Questions on that? Now, one of the other things to think about is this is just job loss. There are many other ways that housing is hurt by changes in the employment market. For example, when corporate profits start to fall, so do bonuses. So if you relied on bonus for part of your payments, that hurts you. Also, some workers lose second jobs, but not their first jobs if they were working 2. That doesn't necessarily show up here. Also, you may see your hours curtailed. They cut back the number of hours, cut you from full-time to part-time. You didn't lose a job, but your income certainly got curtailed. So there's lots of other ways that income is curtailed other than just losing a job. And all of those things have been at play. If you add together people who are unemployed plus people who are underemployed, it's far and away the highest that it's been since World War II. So, and we're still not at the end of all of that. That just sort of gives you a picture of the path of job losses from the last recession to this one. And you can see much deeper job loss in this one compared to the 2000 recession. But I show you this because it's likely to feel like the recovery here from an employment perspective is very much like that one. You recall people calling it a jobless recovery. It's going to feel like that if we only grow at about 3%, because the economy won't add many jobs at 3%. Businesses will extend the working hours, take people from part-time to full-time. Those are not new jobs, right? They're simply expanding the use of the labor that they have before they're adding new people to the workforce. So it's likely to feel like a jobless recovery. That's that broad measure of unemployment that I was talking about. Now, two things about the average work week, and here's one of those things where you have to watch economists because they try to be tricky on this stuff. I know some of them, and they're definitely tricky. So a lot of people say that people use statistics, and this is a rightful accusation of economists. They use statistics much in the manner that a drunk uses a lamppost, more for support than illumination. So if you hear people talking about the decline in hours worked, the first thing you have to recognize is, gee whiz, this has been going on since World War II. Well, it has. Actually, we've been increasing the productivity of our workforce so we can get the same amount of output and not work them as hard. Although I know a lot of people work very hard, most all of us work very hard, because of tools that have been added to our repertoire to improve our productivity. We've been seeing significant improvements in the hours that we have to work. So you can see there's a long-term secular decline in the average hours worked that's born of those improvements in productivity. But you can also see that sort of flattened off for a time period as the gains in productivity started to level out, and then most recently a big drop-off that's clearly related to the recession. So you have to kind of sort through the long-term factors versus the short-term factors. Obviously, unemployment all across the country, up in North Dakota, not too much going on there. I'm related to most of them. They work whether you pay them or not. So they're in pretty good shape. There are some folks, I met some folks here from North Dakota. Yeah. They agreed, they signed off on that. One of the things that's going to contribute to growth, I said, is inventory rebuilding. So what's happened is the pace at which companies are cutting their inventories has slowed down. That will actually show up as an increase in economic growth. You probably are familiar with this, the Cash for Clunker program. And it's one of those things that has led to that inventory rebuilding. But let's talk about that for just a minute. I drink a lot of water because I rely on natural forces to get me done on time. So in the recession, big downturn in auto sales. Auto sales at the peak of economic growth were selling at about 16 million units per year. That fell to 9 million units. That is a dramatic downturn in business. So we ran the Cash for Clunkers program. What happened? The sales spiked up to about 11 to 12 million dollars or units per year annual pace. But as soon as the program ended, right back down to 9 million units. Now, I think as the economy recovers, that's going to come up, but it'll be a while before the auto industry is selling 14 million units. Ellen Hughes Cromwick, who's the chief economist at Ford, serves on the board of the National Association of Business Economics with me. And her modeling says that they expect 14 million units is about the run rate, considering scrappage and replacements and household structure and all that kind of thing. We're a long ways from that. Now, a couple of things to think about here. First of all, used car prices have risen. Probably shouldn't be surprised by that, right? You just took, 600,000 used cars out of the supply side of the equation. It shouldn't be a surprise that prices would rise, right? So that will cut back on sales of used cars to some degree. Auto parts dealers are most interested in the oldest vehicles because they're the ones they sell the most parts to. So I would expect you'll see a decline in sales at used parts dealers. People who did the cash for clunkers, some of them supplemented that $4,500 benefit that they got by borrowing money to buy the rest of the car, right? In the midst of an attempt to get our consumer sector deleveraged, it encouraged some releveraging. That consumption probably came out of either their savings or consumption of some other thing, so it substituted for that. So the question is, exactly how much of a longer-term boost did it give to the overall economy? It definitely helped the auto industry in the short run, which was part of its objective. But in terms of a broad-based stimulus, I think you can raise some reasonable questions about its sustainability. Now, the most fun fact, in the course of that program, while it was underway, there were two, this actually happened, there were two old Russian subs that were sighted off the coast of New Jersey, and the WAG suggested they were coming over for the Cash for Clunkers program. I thought that was kind of cool. History is better. I mean, real life is actually better than comedy. So here's some good news. In the services sector of our economy, it's come back to the space where it's not shrinking. That's really critical because 89% of our workforce works in services. So manufacturing is still very important to us. And at its peak prior to this recession, we were actually producing the highest dollar value of manufactured output that we ever have in the history of the country. That probably is a surprise to you, a lot of you. But in fact, 89% of our workforce is in services. So it's critical what happens there. And the good news is here that the number 50, that level 50, means services are neither contracting or expanding. If it's below 50, it means it's contracting. If it's above 50, it's expanding. So we've gotten back to the point where we're no longer shrinking in services. And then I would expect going forward, gradually we'll see that number go up, so we'll see some expansion. Now, you know all about the residential problem, but commercial real estate is a lagging indicator. It always goes down well after the recession is underway, and that's what's happening now. And it has a big carryover to the financial sector, and because of that, it's also going to affect the recovery pace of the residential sector. And I'll talk about that a little bit more in a minute. This is chain store sales. It's a way of measuring activity of consumers. So the green line is Walmart. And you notice that it's truncated. Walmart stopped reporting. So the Commerce, because they're such a big chunk and they were doing so well in the recession, so the Commerce Department's talking to them about getting them to report again. But what's interesting is even in the depth of the recession, Walmart was doing very well. That's because people were moving down the chain to basic goods from more luxury or discretionary goods. So you see the brown line, that would be Walmart's competitors like Target. So I always talk about Walmart first because my sister works in the executive office for capital planning for Target. So if you want a Target store near you, you have to go through my sister. But it always hacks her off when I talk about Walmart. So I always start with Walmart, and then I call her and say, hey, I talked about Walmart today. And she doesn't send me a Christmas present. So you can see even Target took a hit in that downturn, but they've recovered. The red line are companies like Saks, which, to illustrate the height of the downturn, Saks had a sale. I understand that's a first that ever happened. Anyway, I talked to the chief economist of Saks, and he said they are revisiting their entire business model because they believe there is a structural shift that has taken place in the outlook of consumers and households that will permanently affect their business model. And you can see the magnitude of the downturn for them in this recession. And I think a lot of the high-end retailers are doing that same thing, reevaluating their business model because they believe there will be a fundamental shift that will take place among consumers. I think that will also affect housing. You can see consumer confidence is coming up, but it's basically not up to even 2 standard deviations below the average level of confidence. So we have a long ways to go. But think about the consumer's problem. Their income has been curtailed, whether they've lost their job or not. Many of them or their neighbors have lost their jobs. The value of their house has plummeted significantly. The value of their stock portfolio has fallen. And if they're, say, a boomer in peak income earning years, the last 2 stimulus packages have told them very clearly, you're going to pay for this. Because there was an income cap above which you got no rebate. And people who didn't earn money or did not pay taxes got a rebate. That's called an income transfer. If you didn't get it the first time, the second time, you should have figured that out. And so that's part of why we believe there is a long-term structural shift that's going to take place, because people realize they're going to have to work longer, and their after-tax income isn't going to be as great as it was previously, and they have to rebuild that wealth that they lost from the peak, whether in housing or in their stock portfolio. So these are all part of our arguments for why we expect this to be a weaker recovery. Now, obviously, looking at financial markets, which is sort of the epicenter of all of this, we want to know how does it look historically. The Kansas City Federal Reserve puts together this nice index it measures about 11 different things out of financial markets, both prices and quantities, and puts it together in an index. And this chart has a couple of really useful attributes. First of all, you see that there was another disruption in the last 20 years. That was, and I think I talked to you about this last year, about long-term capital management, the Asian debt crisis, and the Russian bond default, all in the 1998 time period. And you can see what happened to risk premiums there. The jump in the middle of the chart, that's what happened to the risk fears of participants in financial markets. It widened out significantly. The mortgage space, it widened out about 65 basis points, but most interestingly, it stayed wide for 5 years. So, we come fast forward to today, you can see the magnitude of this disruption much, much greater than 1998. We're back basically to the average of where we were for that 5-year period after 1998, but we have massive governmental intervention in capital markets. The Federal Reserve, for the first time in its history, intervened in a specific market, targeting the interest rates and risk spreads in that specific market. They've never done that before. And by the time they're done, they'll have $1.25 trillion of that asset on their balance sheet. They've never done that before. All of that to bring down risk premiums, and there are other programs too, not just the mortgage program, but all of those things to bring down risk premiums only to the average of that last 5 years. So the question is, what happens when that support is withdrawn? Why would we believe that private market participants would bring risk spreads down to the previous beneficial levels anytime soon when this was focused in the mortgage space? Remember, I said those spreads back in 98 were in the mortgage space widened out. It wasn't a mortgage event. This time it is a mortgage event. Why would we believe that private markets will bring those risk premiums in anytime soon? I don't believe they will. I think this chart helps make that point. Obviously, the bank's still dealing with the side effects of a host of bad assets. I put this up simply because it gives you some relative comparison to the 30s when we had all the banking holidays. You can see the losses very large relative to the 1930s. So the banking sector is still recapitalizing. Net new credit extension in the banking sector year over year is 0. There's a lot of reserves out there, but they're trying to build capital. One piece of evidence of that, they're buying Ginnie Maes. Why are they buying Ginnie Maes? Because Ginnie Maes have a 0 risk weighting in terms of capital. So you put a Ginnie on, you don't have to add capital because it has the full faith and credit. So you can have of the federal government. So you can have an income earning asset on your balance sheet, but you don't have to allocate capital to it. Capital is very scarce in this environment. That's why banks are not extending new credit, which is risky credit. So ways to go. There's the Fed's balance sheet, that light blue space. That's the addition they've made of mortgages. I started a little controversy within the company in August in my forecast. I put in there the words, the following 3 things. I said, thinking forward, the Fed has announced they're going to end their mortgage purchase program. We believe that when they do, something on the order of 50 basis points risk premium widening in spreads will result from that. At the same time, there is a law in place that says Fannie Mae and Freddie Mac, starting January 1st, 2010, have to start shrinking their portfolios by 10%. And we're assuming that the Fed doesn't sell off those assets that they've put into their balance sheet. We also believed at that time that they would extend past December 31st out to the end of March. And the 3 rules of forecasting: if you give a number, don't give a date. If you give a date, don't give a number. If you get it right, don't look surprised. So we got it right. At their next meeting, the Fed pushed it out to March 31st. But there was a logic to that because they have a bunch of programs that they have to end, and it was clear they'd been experimenting, buying at different points to see what would happen to rates and how sensitive activity was to those changes in rates. Right now, borrowers are very sensitive on the refi side at 5%. If rates go up to 5.05, applications fall 10, 15%. If they go to 4.95, applications rise 10 or 15%. So they've been experimenting by managing rates and spreads to figure out how sensitive the market was going to be. We felt, our view was it was still very sensitive, and they weren't ready to declare an end to that program until they had perhaps 3 quarters of growth for the underlying economy to rely on when they start removing support from the housing. Some of that dancing and people were doing last night threw up some dust, so I know nothing. So this, basically the gray bars here are the Fed purchases of MBS. The red bars are net new issuance. What this says is the Federal Reserve is buying more than all the new MBSs that are issued. In other words, they're buying some seasoned MBSs as well. So they are the market for current production. So it is a big deal when they stop purchasing. There is a big question: who replaces them, and at what yields will they be willing to replace them? This is FHA production. So the far right bar is the first quarter of this year. All the other bars are annual totals. So what you can see is it's not just Fannie and Freddie and conservatorship, it's the Fed buying the MBS, it's also FHA. 95% of the mortgage market today is government. All the critical risks in the marketplace today are policy. That's all the important risks that you face. So that last bar shows that in 1 quarter, FHA produced the average annual amount for about 4 of the last 5 years. Huge growth in FHA. Raises a lot of really interesting questions going down the road about the health of FHA, the sustainability of it, and its role. You do sort of have to ask yourself a question: what does a $730,000 FHA borrower look like that uses an $8,000 tax credit and 5% down? Right? I mean, that's kind of an important policy question to think through. With regard to who's going to replace the Fed in the purchase of agency debt or MBS, you can see here on the debt side, that is purchasing the bonds of Fannie Mae and Freddie Mac, you can see that foreign official sources, foreign central banks, have reduced their purchases and are actually selling off to some degree. So that's an important question when the Fed removes both its support for MBS, but also for the direct debt of the GSEs. The GSEs' costs will rise, and the question is who steps in to provide that funding. Quick look at housing. No matter which way you measure affordability, accepting credit, affordability of housing is as good as it's ever been. Prices have fallen so far that housing is very affordable. And you're starting to see some pickup in sales as a result of that. For those folks who are high credit quality or can use cash, it's a great time to buy. Because most believe, and we do too, that if house prices aren't at the exact bottom, they're approaching it. And they're well over halfway toward the bottom. Again, bearing in mind, every part of the market, with the exception of the jumbo space, has direct government intervention, so you don't know when or how that support will be removed, but that will impact the behavior of the market. There's just a little look at the house prices. It contains loan performance. They put out a price index. The FHFA puts one out, and then, of course, Case-Shiller. You can see that with loan performance and FHFA numbers, the prices bumped up a little bit. Is that sustainable? Well, it's kind of hard to say. People are trying to figure out what's the impact of this temporary tax credit, which ends November 30th, right? And so basically the deal has to close by then, so most anything that's going to qualify is already in there. Anybody in here have a 4-year-old that bought a house? Did you see the news reports? I forget how many children 4 years old bought houses. I thought that's a far forward investment strategy that you wouldn't normally associate with a 4-year-old. But at any rate, so the question is, when you remove that policy support, what happens? So we were looking at starts, which came out. Starts were not up nearly as much as forecasters had estimated, and the previous month's starts measure was revised downward. So maybe that's a sign that, in fact, part of the pickup in starts and the support in prices in the short run was bringing forward demand in time, and giving a temporary support to those sales numbers. Then existing home sales came out very strongly up. But if you looked at the data carefully, you saw that the percentage of first-time buyers, which is what you have to be to qualify for that tax credit, only rose from 30% to 31%. So you'd sort of say, well, the starts numbers might have given some support to the idea that it was a boost from the tax credit, but the sales numbers didn't seem, you'd have thought there would have been a bigger rise in the percentage of first-time homebuyers if that was what was driving that. So it's still not clear what the role of that tax credit is in the overall data. That said, the biggest problem on the market is excess supply. And so the first thing that you have to see is the supply of homes start to go down in order to restore the balance of negotiating power between buyers and sellers to something close to equality. That's what most people think about when they ask, are we at the bottom? What they really are trying to get at, I believe, after hearing the question a few hundred times, is when will buyers and sellers have equal bargaining power? Because that's usually when prices are relatively stable. I didn't put it in here. I think I showed you. Did I show you the swimming pool chart last year? Oh, I blew it. I should have put this. To explain it to my mother, I put it in the swimming pool chart. Basically, you can think of the surface of the water as the month's supply of homes on the market, and then there's pipes pumping water into the pool, and there's drains draining water out of the pool, the pipes pumping water into the pool, new homes completed and available for sale, people that offer their existing home for sale, people that buy apartment buildings and convert them to condominiums available for sale, and foreclosures. All of those pumping water into the pool. The one that's pumping the most water in the fastest is foreclosures. So we got lots of policy things underway to try to slow the water coming through that pipe and to reduce its volume. The drains, new home sales, existing home sales, destruction annually. There's about 300,000 houses that are destroyed annually, either by storms or from obsolescence. People that take condominiums and convert them back to apartments, and let's see, there's one other one. The people that withdraw their existing home because they don't have to sell it and they can't get the price that they want. All of those empty the pool. Of course, those drains have filters on them, and the drains are credit conditions, and they're incredibly tight. And amazingly, more than 2 years in, banks are still tightening credit conditions because now they have trouble on the commercial loan side, and it's going to constrain capital for them, so they're also tightening conditions still on the residential side. But this is good news. This is the lowest level of new homes available for sale since 1993. So on the supply side, it's been very painful, obviously, for the builders, but we've seen a slowdown in the pace at which that pipe is pumping water into the pool. So there's that little bit on the way far right there, that little jump up in the blue line is the basis of lots of the optimism that's reemerging. This is, again, one of those places where you want to be careful with the statistical tricks, because on a percentage basis, that's a big increase. On a numerical basis, not so big. It's just that it's from such a small base that the percentage change there will look big. So it's sort of like when you go from one foreclosure to 2 foreclosures in a neighborhood, it's a 100% increase, right? Statistically, it sounds really scary. It says, well, there's only one more house out of 1,000, right? So regionally, pretty balanced. Regionally, these bars are just the different regions, and 2 quarters we've seen starts pick up. The question is, did we just bring things forward with the temporary tax credit on the builder side? Looking at inventory sales ratio, you can see that existing home supplies are coming down. Condo supplies are coming down also, but still very much more supply on the condo side than on the single-family side. We've got a ways to go. But of course, if the sales pace picks up, then the ratio falls, just like if the number of properties falls. So you have to think both about the numerator and denominator here. Pending sales bode well. In other words, the advanced contract signs say that borrowers are still going to be buying. It looks good at this point, like we've reached the bottom of the transactions. I went back to this because I was out there on the right-hand side. You see another level drop-off in the October timeframe. That's when the credit markets really melted down. So one of the questions is this recent run-up in sales simply sort of backfilling that extra step down that the market took when the credit conditions really went bad? So that we should expect the first 9 months roughly of 2008 as sort of a long-run path on which we would expect housing to go. If we go back and answer that question, that in the long run, the sustainable home ownership rate is something more on the order of 65% than 69%. Then what has to happen is something like 4.5 million houses have to transition from owned to rented. And we don't know exactly what that number is. There's no good science on what is sustainable, but it clearly wasn't 69%. Now here's a way to get at that. The Census Bureau once a quarter releases vacancy data on owned homes and on homes for rent. So in the most recent quarter, the vacancy rate on owned homes fell from 2.9 to 2.5%, and simultaneously the vacancy rate on rented homes rose from 10.1 to 10.6%. That represents a migration of about 300,000 vacant properties from vacant to be owned into vacant to be rented. If indeed the homeownership rate is going to fall on a sustained basis, that must take place. And that takes supply out on the sales side, and that's a good thing in pushing us toward stability in the own home marketplace. We need to see that continue. Some people argue, well, those are discouraged sellers, and so they're going to be residual supply, and every time price improves a little bit, those will get sold back into the market. And that's not true if indeed the homeownership rate is going to fall to 65%. That will become a permanent shift into the rental side of the equation. They may sell to another investor. They may not want to become a landlord, but they will sell to another investor, and that property would stay there and not become residual supply for the owned side of the equation. We have a lot at stake in that question of what's the long-run sustainable rate of home ownership. I commented earlier that the one part of the market that does not have direct governmental intervention is the jumbo space. And in that space, 30-year mortgages are running roughly 100 basis points above non-jumbos. Traditionally, that would be more in the order of 30 basis points. That is, to me, a signal of what risk premiums are going to do when the Fed removes its policy support. They are going to widen. I don't think they'll widen 70 basis points, because part of the reason the jumbo space has that bigger premium is it's a thinner market. There are less trades. And also, traditionally, prepayment speeds in that part of the market are much faster, so there's a premium in rates for that. But clearly, the market in its one private market segment is signaling wider spreads or more yield per unit of risk is going to be demanded by private capital holders. This is a chart I talked earlier about how sensitive refinance activity is to the 5% rate. So that the horizontal line at 0%, that's basically the 5% interest rate. You can see when rates go above that, you see a drop-off in applications. When rates go below it, you see a jump. It is the sensitivity point at this point. Applications are trending up across the board, but again, a lot of that is supported by policy interventions. Here's the green line here is the government share of purchase applications, FHA and VA, are 40% of the home purchase loan applications being taken today. Big drop. They haven't been at that level for over 20 years. You can see in 2009, big jump in volume relative to 2008. That's the policy interventions, again, most particularly the Federal Reserve's intervention to drive down rates and risk spreads. That led to a significant rise in loan production volumes, particularly on the refi side. Our expectation is when they remove that support and rates and spreads widen in 2010, you'll see a big drop-off in refinance activity as a result of that. And finally, back to the chart of where are these foreclosures going to come from. The darker the color, the higher the percentage of seriously delinquent loans, that is 90 days of past due or in foreclosure somewhere. And it's the usual suspects, the sand states, California, Florida, Arizona, and Nevada. I don't know if they like being called the sand state. Anybody here from one of those states? You like being called the sand states? Indifferent, not sure, going to think about it, talk to you at the party tonight. Okay. But that's California, Florida, Arizona, and Nevada. And then in the upper Midwest, it's the states that have yet to undergo a complete structural adjustment to sort of the post-heavy industrial environment. So Michigan, for example, Michigan's a poster child. They lost, I think, another 160,000 private sector jobs this past year. That would be, since 2001, they've lost almost 750,000 jobs. If you had not built one house in that time period, house prices would have fallen, simply because it's all demand-side destruction. Until you reverse the economic prospects of the state, housing will continue to suffer. But it's a lag. It's suffering from other factors, not a driving factor itself. The sand states much more about housing policy. So if you think, I made a joke earlier about selling houses to people who don't have jobs, but in a very real sense, we were doing that. We told you, look, we're going to change the tax law related to capital gains. We're going to say now, instead of having to take the capital gains and reinvest in a house within 2 years, you can take the money and do whatever you want with it. And then we're going to raise the amount to $250,000 per person or $500,000 for a couple. And what we'll do is we will lend you 100% of the current value of that property, and all you have to pay us is some after-tax interest. That's not a bad speculative tool, right? So guess what? Guess which states there was a lot of that? And each individual builder was building properties believing that it was sustainable demand, but if you aggregated across all of them and looked at the supply of homes coming on the market, you say, something's wrong here. We have very large volumes that are way above the level that demographics would indicate what's happening. And what was happening was a lot of speculative overbuilding as spurred by part of our tax policy in housing. And now we're paying the price for that, particularly in those 4 states, but not exclusively there. Other areas have seen that as well. So let me summarize in a headline our outlook. We expect a moderate recovery, roughly half the pace of the post-World War II average for the first year, a little bit more of a pickup in the second year, but you know what? All the risks in the market are policy. And so it's very difficult to ask Kurt, it's very difficult to forecast policy. So I'm not bad enough at forecasting interest rates, I don't forecast policy. So you sort of run your models believing the current state of affairs will continue where policy is concerned, even though you know it won't. And then what you have to do is talk about the risk. Well, the Fed's removing some risk, or removing some support, according to their statement. If they see 3 consecutive quarters of at least modest economic growth, I think they'll keep that word. That means rates and spreads will likely rise. And for the mortgage market, we believe that in terms of transactions, it's bottomed, the numbers of transactions, but that doesn't mean that house prices have bottomed, because in those markets in the past where they have fallen, they typically continue to fall for a little while even after transactions pick up, because the whole market hasn't realized that the bottom has passed. And then after a while they catch up. So we expect to drop from about $2 trillion in mortgage production to about $1.5 trillion in mortgage production from 2009 to 2010. So that's the headline. And I'm sticking with it until I change the forecast next month. That's the other rule of forecasting. If you have to forecast, forecast often. So questions?
Yesterday when Dr. DeSoto spoke, I found it interesting. I understood the concept in his book about identifying assets. Mm-hmm. And what we do ties into that, of course. But I didn't connect the dots with how that impacted the TARP money that was given. And I would be interested to know your comments on his theory about the fact that the TARP money was given without tying them to a specific asset, and how you think that will impact the economy specifically with regard to inflation.
Yeah, I think his point is one of transparency. And I'm a free market-based economist. I think that the role of government is, it has many roles, but one of its role in markets, particularly financial markets, is to attempt to help balance the symmetry of information so that both sides of the transaction have relatively equal or symmetric information on the transaction they're about to take. That was not the case in lots of the derivatives, because you couldn't look through them to understand what the real asset was that backed those things. A lot of times I'll make a comment that I'm not part of the self-esteem movement. And what that means is there are wrong answers. Right? So I like the reports of the press about American students being 15th in the world in math and #1 in feeling good about it. That doesn't work very well for me. So there was a little bit of that kind of math in the derivatives space, and CDOs and CLOs, some of those things. So what they basically said is, we'll take the B tranche from each of 10 securities and package them into a new security referencing each of those 10, and then we'll rate the top 80% of this AAA. I'm like, so 10 Bs added up gets you AAA? The math didn't work for me. So it wasn't only that the math didn't work, but it was also very difficult to tie back to who the owners of those assets were. So from the perspective of your industry, you would be saying, well, we'll title each of those so that you can identify them in a record, and it will be very clear when we apply the TARP money exactly where we're going to go to get which asset, and we'll be able to price that asset. Turned out it was a mess. There was no way that you could do all of that. So I agree with him. It was a very valid point and a good way of characterizing that. Are we going to get inflation? That's a second question to which I'm a monetarist, so I would say the risks of that are very high. It's not as though banks don't have any liquidity. Every year I pick a favorite chart. I didn't throw my favorite chart. The swimming pool was last year's favorite chart. This year's favorite chart was a chart that showed, in fact, I may have showed you this last year in Hawaii, of excess reserves in the banking system. Anybody remember if I showed you that? Basically, banks have required reserves that they have to hold to be a part of the Federal Reserve System, and they can hold excess reserves if they want. But up until this year, they weren't paid interest on them, so they minimized those. They ran at somewhere around $50 billion forever. For a long 20 years, it's a flat line. And then all of a sudden, in October of this past year, it goes straight vertical. It's rare that you get that interesting of a turn in pure data. What happened? The market melted down, and they trusted no one. So whatever reserves were pumped into them went purely into retained reserves because they had no idea who was safe to make trades with. All of that liquidity, some 800 billion of it, is sitting there, and if credit conditions were to ease and that flowed into the economy, you would get a rapid rise in the price level, which would be inflation. So the Fed has been very explicit about the things it believes it can do to absorb that liquidity prior to it entering the economy and becoming inflationary. That's why they're doing all that messaging. The fact that Chairman Bernanke was on 60 Minutes or whatever, I did a 3-part series on some television show, op-ed pieces in the Wall Street Journal, they've never done that before. So they're absolutely concerned that capital markets should believe them when they say, we have tools that can absorb that liquidity and not make it inflationary. We'll see. We've never run the experiment before.
Hey, Doug, I get to shot the last question here. You showed a chart which demonstrated very clearly that the only reason our structured capital markets are working now is because they belong to the government. The government obviously has to pull back. What policy steps still have to be taken to restore trust, to the structured assets market? What do we have to do to get private investors back in the mortgage-backed securities space? Are there specific things the government should do? Are there things we can look for to know that we're on course or off course? And sort of, what's the time it's going to take to heal that part of the economy up again?
Well, I always look for signals that are out there that would give some indication of what private capital holders are thinking. So here's 2 or 3 things. One, unsecured creditors in banks were made whole. Unsecured creditors in the auto industry were wiped out. If you're big private capital, you look at that and you say, I'm not ready to take risks yet because the rules of the game changed within a 6-month period. So that's the first thing. Second thing is, there was a lot of discussion about mark-to-market rules in assets which are in thinly traded markets, and what should we do about them? So the Treasury Department was preparing a TALF program which would buy those troubled assets off of bank balance sheets, and the day before they released the TALF program, the FASB announced a weakening of mark-to-market rules. Guess what happened? Nobody sold into the TALF program because now you didn't have to actually mark them to market and recognize the loss, right? And then bank stocks went up. To me, all of those things say there are still problems on bank balance sheets. Otherwise, they wouldn't be buying Ginnie Maes, which are use no capital, and there would be positive net new bank lending because spreads are wide and therefore very profitable. So we've not yet dealt with that fundamental question. Going forward, one of the things that was what we were just talking about here, which is transparency. People are going to require the ability, investors are going to require the ability to look into an asset and understand its characteristics, what they're buying, what do they own when they invest in that, and the predictability of its yield. And I think that means there have to be some exchanges put in place, and there have to be some rules for reporting on some of these. It's a place I, as a free market participant, am completely supportive because it gets at that issue of making symmetric the information between the seller and the buyer. And I don't think you're going to be willing to invest in those securities until you know how they are secured and exactly what's the asset that's backed by it. It's good? Okay, thank you very much. I'll be around if you want to ask questions later.
Ladies and gentlemen, once again, please welcome Mike Pryor.
Good morning. It has come to my attention just now that there has been a serious breach of staff ethics, and I want to acknowledge publicly. You notice our staff is in red and white shirts today. It appears that Cornelia Horner, our Alabama Crimson Tide fan, thinks that she's getting all these people to support Alabama because they're wearing red and white shirts. So, in order to blunt the manipulative effects of this breach of ethics, I'm going to declare these shirts to now be Arkansas Razorback shirts, and so y'all are okay. We'll try not to let that happen anymore ever again. Some of you have seen that Jerry Seinfeld is in the building. Have you seen him yet? No. Well, he's in the building, and the word's kind of getting out, and because Cornelia has done such a great job on entertainment. So let me just let the secret out right now. Jerry Seinfeld will not be at the banquet tonight. So I did just speak to him, though, and he did give me this word for you. He said, please tell your group. He said, please tell them if they get back home and they get an email from their Department of Health warning them not to eat canned pork because of swine flu. He said, tell them to ignore it. It's just spam. So, all right, sorry. That was his, not mine. No, I mean, hey, if you want it can get worse. If you get swine flu, you need ointment. If you have bird flu, you need tweetment. And there you go. Now, that's it. That's as close as we're getting. We have some business to conduct today. This would be a good time to move into that. So, at this time, there's several people I would like to recognize, if you'll allow me a few moments. We've had a great board this year. They've done an outstanding job. We have a couple of people who are leaving that board this year, 2 of which are not present. Ted Rogers and Gary Kermott will both be departing the board this year. But we have Mike Nichols. I saw you earlier. Mike Nichols, please stand. Mike Nichols and Mark Bilbrey. Mark. These guys have rendered outstanding service and given of their time and treasure to support the efforts that you have seen happen at this convention, and we definitely want to give both of them our sincere thanks. All four of these guys, our sincere thanks. Kurt mentioned earlier today that the time that Mr. Winter would be spending next year as being president of this association, but there are people in this room who have carried this job before. And, you know, I think it's always appropriate that we remember and honor and recognize their service, because you just kind of never recover from it. It's a great honor, but you spend a lot of time and effort at it. And I just would like to call out the ones that I have seen here. Malcolm, you in the room? Please stand. Malcolm Morris, past president. Kara Dietrich. Kara. I can't see. Thank you. Chuck Kowaleski. Now, Chuck's easy to find. He may be around back. There he is, over there. I get this Bilbrey guy. Mark, please stand. Randy Yeager. Randy, back in the back. And Greg Coulson. Greg. Did I miss any other past presidents? We always want to make sure that these guys are recognized. They've given many, many hours to bring our association to where we are today. There's someone else I would like to recognize as a point of personal privilege, if you will allow me to. John Dozier is, for as long as I've known John, he's been chair of our SLRAC committee, our State Legislative Regulatory Action Committee. This is his last year as chairman of that committee. His service has been enormous. I asked special things of him this year in preparation for this year. He performed them admirably, well. John, are you in the room? John Dozier? When you see him, let him know that we deeply appreciate his service. And finally, if I can, one more point of personal privilege. I've had a companion this year that has traveled with me the last couple of years. She has put her personal life, her personal interest, her personal business, and her family on hold in order to support this passion that I had. She's been to state association after state association. She's here today. Please welcome and help me thank my wife, Lynette. Please stand. Thank you. You know, there's another element of this association that you rarely see, and that is we have a special award called an honorary membership. It's very rarely given. It's given to members who have performed distinctive and meritorious service. Those are the words. And it's only awarded by the Board of Governors. And it doesn't happen every year. It doesn't happen every other year. It only happens in that special time, that special place, that special moment for that special person. And at this time, I would like to bring forward one of those special people who has received this award in the past. Our past president, honorary member, Kara Dietrich, to present the latest action from our Board of Governors. Kara, please come forward.
Thank you. You know, I'm here to honor Mark Bilbrey, is who I'm here to honor. And it's the highest honor you can receive in the American Land Title Association. I'm here to, he will be worried about this, but I'm here to embarrass him. But not in the way that some of you think. We could roast him for days. We could literally roast him for days. But I want you to know he's the 56th person to receive an honorary membership. We've been going for 102 years. So there's been a lot of people before us who've received this honor. But he's going to join 15 of us who survive. So that'll be 16 surviving members of the honorary membership. You know, we could all give our perspective of Mark, and there's many of you who would like to stand in my shoes. well, maybe you don't want to stand in my high heels, but you would like to be up here and be able to be the one to give him this award. He's so close to so many people, and I'm very honored to be able to do this for you today, even if I am going to embarrass you some. Mark thinks of himself as the Joe average title guy. I've heard him say it hundreds of times. That's all I am. I'm just the average, ordinary guy. I'm just doing what I do. But you may know him as a very funny guy. You may know him as the king of the one-liners. You may know him as a very passionate man in his work, very thoughtful in the things that he says, very compassionate to people. You may know him as a consensus builder, and you may know him as a true friend. I want to share a few beginnings for Mark. He was born to Hugh and Jewel Bilberry. He was their third child. He was their baby, and he was a cutie. Boy, he had red hair and a bucket of freckles, and it was just amazing. I don't know how anyone could resist him. His dad was a rural mail carrier, and he set a lot of examples for his family. One was hard work. Mark always was a hard worker, but he always set an example for compassion. Being a rural route carrier, he met a lot of people who were very needy, especially in those years, and he helped them in every way he could, and he never did it for recognition, and he never did it for reward, and Mark saw all that. And he saw a very ordinary man do very extraordinary things for a lot of people. His mom was a stay-at-home mom. Kathy says she was the best cook in the world, and that's probably fortunate for everyone, you know, that she fed them well. Mark was quite the dude in high school. If we could have had the time, we would have had quite a slideshow for him, and I would have loved to do that, straight from the bare butt on the bearskin rug all the way up. But we didn't do that. Fortunately, we had no time. He was very popular in high school, though. He played sports, of course, but he was chosen as Mr. OHS. Now, his high school name was Olustee High School. Their motto, as you can imagine, had a lot of things, but one of the cleanest was, "Lust is our middle name." So, keeping that in mind, he was voted Mr. OHS. He was also voted the basketball royalty king. He was voted the most likely to succeed. He was voted the best dressed. And from the pictures in the yearbook of the adoring looks he got from the girls, I think that he, had pretty smooth moves then. Which tells you how he received all those awards, because they only had a class of 20, and I'm guessing that the girls swung those votes. And he's blushing. This is good. Seriously, though, he went on to junior college at ALTA, and there he met a man, Harold Cotner. He worked for him at Jackson County Abstract, and Harold taught him the beginnings of the title industry, but what he really taught him was politics and an appreciation of old cars. And it was interesting because Harold took Mark under his wing, and he took him campaigning, and he took him kicking tires. Now, what does that have to do with the title business? It was Harold's passion. He went on to become a state representative, so Mark had a good beginning on how you influence people, how you impact, how you go out and campaign, how you do the glad handing, how you be sincere. And it worked. It took. Mark and Harold remain good friends to this day, and Harold's very proud of Mark. He's appeared many times to show his appreciation and to support him. He finished his formal education at OU. If you know him, you know that cemented OU into his life forever. And he started then working at Oklahoma City Abstract. By then, he knew what he wanted to do in his life. He did get a degree in accounting, which doesn't exactly fit with us, but he got his degree in accounting. And he took an opportunity to move to El Reno. And he thought by joining Guaranty Title, he could slow his pace down a little bit. He could have time to raise a family. He could just be in a rural community and follow some of the footsteps and the examples that he learned. Then he became president of Guaranty Title, and of course that was out the window somewhat. But during that time, after he became president, he hired a stunning, vivacious, redhead, a very beautiful young lady, Kathy. And a year later, he proposed to her, and they were married shortly thereafter, and he has said time and time again, I had to marry her, I couldn't afford her. So he and Kathy combined their yours and my kids, and they added an ours, and they made it their entire family, and that's what they launched themselves into from then on. Their family first, and then their business, building Guaranty Title. One of Mark's extraordinary talents is to make people comfortable and feel important. So he gained a lot of friends, he gained loyalties in his community in El Reno and through Oklahoma City. And he's just been an outstanding person in that community, supporting all of the community affairs and was building Guaranty Title at the time. He never meets a stranger, never. And how does he greet you when he sees you? He says, hi, friend. That's what he says every single time. You can message him, you can text message him, we do that. And he says, hi, friend. That's what he says every time. He's the rock of support for his sisters and their families, for Kathy's parents, and then now her mom, and for their kids. He's been a loyal member of OLTA for years. He met John and Winona Kathy at that time. John's a past president and honorary member. And John and Winona were instrumental in getting him involved in the legislative effort of OLTA. They also encouraged them to be involved in ALTA, and they were a very strong mentor system for Mark and Kathy both. Since Kathy, you talk about loyalty of spouses. Lynette, you have been a peach, and I know what this goes through because my husband was wonderful. Terry was wonderful going through this. But Kathy has been by Mark's side every step of the way. Every step of the way, no matter what. And they are in this together, and they're still sitting right here together. But they were encouraged to go on, and Mark was the OLTA president in 1993 and 94, and that started him in ALTA in 1992. He attended his first convention then, and then he got involved. Rich McCarthy recruited him for the research committee, and he worked in the research committee and then chaired it for 5 years. And it was an interesting time for research because we needed a lot of statistics, and they started figuring out how to provide that. And that came from our abstractor agents group, and that's still going on now. He's also served in government affairs. He's in that for life. We don't get to get away from that. Finance, planning. He's been on the Board of Governors since 1999. He's served on various special committees. He's been the chair of the abstractor agent section for 2 years, president-elect. He was president in 2004, 2005, and presently serves as treasurer of ALTA. He's just an ordinary guy. Joe average title guy. He changed roles somewhere in the middle there and sold Guaranty Title, and he joined First American, and he took a position as Vice President, National Agency Sales Manager. At the time, I don't even think you knew what that meant. But he broadened his perspective. He was instrumental in helping shape the direction of ALTA during those years. And again, he was just average guy, Joe, average title guy, just doing his thing. Doing extraordinary things is what he was doing. He joined OR a few years ago as Vice President and Chief Operating Officer of the Central Group, and he's also President and CEO of American Guaranty Title Insurance Company. He's now still on the board at ALTA as the OR rep at that time, and he's just now going off the board. He's an ordinary title guy who used his talents and his position in ALTA to help us through a really hard period of transition. Tough things to face. He and the board met these challenges with the clarity of vision and compassion that they had to use to get us through that. He's received the highest award in OLTA, which is the William Bill Gill Award for Outstanding Title Person, and he received that in 1996. And ALTA, he receives our highest honor today of honorary member. And there's a lot of things in between I'm not even going to name that came from his community. He's just the average title guy, just the average guy. If you ask him what the most satisfaction and pride he has, he would tell you, I have no doubt, in raising the funds to build a shelter for Youth and Family Services Board in his Oklahoma home area. He would also tell you he's very proud of creating a foundation to bring a hospital to his Oklahoma community. But important in his ALTA life, and I know if I ask you this right now, you would say, it is everyone here. That's what's important in his ALTA life. And helping you make ALTA better. He loves this industry and he has worked hard to earn this honor by his determination in helping you make us all better. You know him as the golfer you can't beat. You know him as for his sharp wit. He is the life of the party, but he is a serious advocate. He is a family man, and he's a doting husband. You can hear him poke fun of his mother-in-law time and time again, and he lives to do it over and over and over. And he's a special friend. Not bad for an ordinary guy, Mark Bilbrey. Not bad. I give you Mark Bilbrey, who's the recipient of ALTA's highest honor, your newest honorary member. Briefly, so you know what this says, it says, in recognition of distinguished and meritorious service to the American Land Title Association and to the science of land title evidency, conferred this 24th day of October 2009 at the annual convention.
Oh, jeez.
He says, I have to say something. He pulls his notes out.
No, I did this because I wasn't sure. You're never sure, and most of you know me with talking about speeches. I very, very seldom write down what I'm going to say because I never know. And I usually work with a situation. I really feel, and as Kira gave a better speech and said things about me that I didn't know. But from that side, I did look at the list, honorary members, and I will be remiss in the fact that I hadn't looked at that in a long time. I've had the privilege of presenting two of those in my life, John Cathy and Jim Marr. Both, I thought, were incredible people, incredible visionaries and dedication to this industry. Never once really did it cross my mind I would fall in that category. First of all, I didn't think I was old enough. Or had accomplished enough. And I tried to say, why is there any one reason anywhere in that report that why I'm there? And the only thing I can say that we have in past is a passion and love for this industry. I think each one of you, this isn't just a job. It isn't just life or death. It's more important than that. And I think that's what we feel about it. As the only thing I hope to take from that group and go forward is to mentor the people in the future that help mentor me to get me to where I'm at. I could go down the list, and as she said, 1,000 people. I could go and tell a story about every single one of you, but you would have a better story about me of something I did, hopefully to make you laugh. But with that being said, my life's always been about the F word, and I've used that a lot. And friends is one of them. Fun. It's a lot easier to laugh than it is to cry, and I'm kind of doing both. Family, and it's priority one. And the last one is faith. Whatever your faith is, whatever religion, that's your choice. But you need to have faith in yourself and this industry. And I think that's proven today. She talked about someone that's been with me, and I'll say it's the person behind the curtain. I use that a lot as you go on this journey. It's kind of like, Dorothy with the little dog at the side. I probably was a dog, but we've made this path. I've got faces and names I could call the Tin Man, the Cowardly Lion, and in all those parts. Kowaleski, you'd probably be one of those. But it's been an incredible journey. It's been, as a lot of people say, I've been very lucky in my life. As a great golfer once said, and again, that wasn't Chuck, the more I practice, the luckier I get. And that's kind of it is. I've thrown myself into this very much. Every step of the way, the person behind the curtain was Kathy. And it really probably should have her name on this. Not a step, not a thing I've done. If it was positive or it made sense, she's the one that did it. I would ask just for a moment, just indulge me. Please give her a round of applause. You know, my friend over there, Mike, is kind of grinning like a possum. He is. And you remember when he first came into this, he told this joke, and he used it and said he would never use it again, about lipstick on a pig. And I've used it and copied him and gave him appropriate credit or blame as I went on. And that's kind of how I feel. I'm all dressed up. This is a new suit, by the way. All dressed up. Kind of feel like you've put lipstick on a pig. And I'm still a pig, but today I feel like a show pig. So, you know, I thank again all of you very much for the honor and the privilege. You have molded my life. All my success can be summed up a little bit with the ALTA and the involvement in this industry. I love it dearly. My wife and I both love it dearly, and it's as our kids would say, the gifts usually go to TIPAC before Christmas. I mean, so they're second on the list. But I want to thank you for the honor and the privilege to do this. I'm not running away. Tough news. I'm going to hang around a little bit because I still love it. There's a saying, and I would say it was to a great man, but I can't remember who said it, so I'll say I made it up. The past should never stand in the way of the future. And I am a little bit of the past. I'm a lot of the past. The future is Mr. Winter and this well-dressed board that we're looking at across here, all my good friends and your leaders. Support them, love them, and help them get through this tough time. God bless you all.
Ladies and gentlemen, please welcome Chuck Kowaleski.
I just want to know if I'm Tin Man, Cowardly Lion, or the other one, Scarecrow, Mark. I need my glasses. We've all gotten a little more senior as time has gone on. Mr. President, ladies and gentlemen of this august assemblage, as I stand before you today, there should be joy in your hearts, more than just for Mark. For this is my last official appearance before you as nominating committee chair. Thank you, Mark. Whatever strokes you might have gotten in your life, they are gone for good. The nominating committees of your association, pursuant to Article 8, Section 17, small b of the bylaws, has spent the last 6 months, virtually full-time, debating the slate of officers and the Board of Governors for this association. I can tell you there was heated debate over virtually every name, Mark Winter. And after those 6 months, we just got tired and bored and gave up, figuring with good cause it didn't really make much of a difference anyway. So we just rolled the dice. Proud of our work, I introduce to you the 2010 ALTA Board of Governors, and I would ask, as they are called, for them to come forward for further insults. Mark Winter, President. This is the first test to recognize their names. President-elect Ann Anastasi, Treasurer John Hollenbeck, Finance Chair Diane Evans, Underwriters Section Chair Chirs Abbinante, Underwriters Section Rep Rob Chapman, Underwriters Section Rep Peter Birnbaum, who is not here, I think, Agent Section Chair Frank Pellegrini, Agent Section Rep Herschel Beard, Agent Section Rep Jack Radican III, and immediate past President Mike Pryor. Now as they stand before you, nope, not quite yet, sorry Mike, it is my dubious honor to install these very well qualified candidates. I have, much to staff's relief, the official installation oath. But every time, and it's over 40 now, that I've done this, I'm reminded of my very first state association meeting on the ALTA tour, which was the Palmetto Land Title Association that met in that year, Myrtle Beach, South Carolina. And at that meeting, either ALTA forgot or I forgot to bring along the official pledge. And I was fretting about that, but the association exec said, don't worry, our pledge is a really simple one I think you can remember. So she gave it to me on a slip of paper about this long, and the next morning I stood up and said, ladies and gentlemen, do you pledge to work your butts off for this association? I remembered it, and it worked. It seemed to work. They had a good year that year. I'll spare you the pain of having to ask and answer that question, and then go to the official one, which reads as follows. It is a privilege and an honor to be selected for leadership by the members of your profession. But this honor is accompanied by great responsibility. Over the years, many officers of the American Land Title Association have borne this responsibility with distinction. Today, you have been called upon to continue in that proud tradition that they have established. You have been chosen to lead the American Land Title Association as officers, and yours will be no easy task. In the coming months, you'll be required to objectively consider issues affecting the public, your economic well-being, and the progress of your and all of our companies. You will find the challenges frequent and the demands heavy, but your rewards will be great. Now, by the authority vested in me, I charge you all and each of you individually with the faithful performance of the duties and responsibilities outlined for your respective positions in the bylaws of the association. And I hereby install Mark Winter as president and Anastasia as president-elect, as treasurer John Hollenbeck, finance chair Diane Evans, underwriter section chair Chirs Abbinante, underwriter section reps Robert Chapman and Peter Birnbaum, agent section chair Frank Pellegrini, agent section reps Herschel Beard and Jack Radican III, and as immediate past president Mike Pryor. And here's the second test. Now I ask each of the aforementioned to raise his or her right hand. Okay, got a good group. And signify their willing acceptance of office and dedication to the high ideals and principles of the American Land Title Association by saying, here's the third test, I will. I will. I think I heard all the voices. May your efforts contribute in ever-increasing measure to the success and prestige of this association and our industry. My congratulations to you all. Thank you very much.
Mark, why don't you just hang around a moment? We're going to formally introduce you in a moment, but while they're finding their seats, we have a few little items of business we can take care of. And while he's doing that, let me just say congratulations, Mark Bilbrey. From me personally, I'm delighted. You've meant a lot to me, and I would just like to make sure you do understand it. You are old enough. We're going to give you a more formal introduction in a moment, but it's your love for this association and my love for the association. And it's your integrity that I know that you've exhibited to me that gives me great pleasure to present to you this gavel of the American Land Title Association. Congratulations, sir.
Thank you very much. Thank you.
Now we're going to introduce.
I just want to say I'm honored, I'm humbled, and I'll be back.
Do you want to do this one now? Sure. We have to do it in the order that they give us on the script, or we get chastised by the staff. So.
Lynette, come on up and join us. Carolyn, come on up. Let's have her.
Oh, that's nice. Look, I hadn't seen that.
Isn't this?
That's nice.
This is the ALTA appreciation plaque. Mike, Lynette, if I may read this. American Land Title Association, Michael Pryor, President, in grateful appreciation by the American Land Title Association. I just want to say one word that I realize I'm following a very special individual. His passion, his wisdom, his commitment resonated from sea to shining sea this year. And it's an honor and a privilege to follow in his footsteps. Mike?
Thank you. Thank you. It's been the highest professional honor of my life, and I'll forever be grateful for it, and I'm here for you to call me anytime, any place, anywhere for the good of this association. You're in good hands. I thank you very much. Thank you. If you will, thank you. Thank you. You get a lot of compliments in this job. And Mark, you're going to get an awful lot of compliments as you go into this job. But it's been said that the highest compliment you can ever receive from anyone is from those who love you, because they're the ones who know you best. And so in that vein, we want to give you a more official introduction, and perhaps maybe even a more personal introduction. And I would like to call forward Tim, Sean, and Patrick Winter to complete that introduction. Please welcome Tim, Sean, and Patrick.
My name is Patrick Winter, and my brothers Tim and Sean will join me in introducing to you your new president. Given that you're here this weekend indicates that you clearly know who he is, but do you? So let us offer a brief introduction from an angle perhaps unfamiliar to you, the perspective of those who don't call him Mark, but those who call him Dad. Now, among other things, Dad instilled in us a love of sports. We come from Maryland, so when it came to baseball, the Orioles were the only game in town. Oh, and by the way, that mallet, he may use that the next time we go out for crabs next time, so watch out. It's a Maryland thing. But so back to baseball. When it came to baseball, the Orioles were the only game in town. And if you were an Orioles fan, you were a Cal Ripken fan, the Iron Man. When it came to our own athletic and musical endeavors, Dad was the Iron Fan. Dad cheered, filmed, and coached each of us. From baseball to football to hockey to golf to wrestling to soccer to one of our music gigs and seedy bars, Dad was there. Through his selfless presence in support of everything we did, Dad taught us that dependability builds a trust and a love that no collection of words can adequately express. And Mom was always right there with him. Now, it's one thing to be an Iron Man like Cal Ripken playing a game, but it's another thing to be an Iron Man as a fan and, most importantly, as a dad. It turns out, Dad, that you've instilled in us much more than a love of sports. The games, the music, the old camcorder recordings that you filmed for us, those will all eventually fade away. But the ironclad sense of being loved will not. Thank you for that gift. And if you bring a tenth of that loving dedication you embody as a father to this organization right here, this is one lucky organization.
Thank you, Patrick. My name is Sean Winter, Mark and Carolyn's third son. I'd like to focus a bit more on my father's work and philanthropic interests. Starting at the age of 2, he was an apprentice at what we think is the world's first Jiffy Lube in Cleveland, Ohio. And then later on in life, he passed through stints as a Cleveland Indians bat boy and a wide receiver for the short-lived Hartford Charter Oaks semi-professional football team. After that, he attended Georgetown University and wound up on Capitol Hill, where I can only imagine those quick feet and many blows to the head served him well. As you all know, in the past 25 years or so, he has focused primarily on the title insurance industry in his work life and has held such distinguished posts as chairman of this association's International Development Committee. He was past chairman of the Underwriters Section, a member of Government Relations Committee, and the Title Insurance Political Action Committee Board of Trustees. And as I was reviewing this, I realized that was a mouthful, so thank God you have that nice acronym that I learned today. So I did learn something today. As clear as it is that he takes great pride in these work-related achievements, his involvement in Living Water International has allowed him to prolong a sense of giving that his family and associates are so familiar with. From meetings with Kenyan President Kibaki and his cabinet to visiting and bringing water to Ethiopian villages and the Maasai tribe and building wells. My dad has taken such pride in these accomplishments, and it's truly a part of who he is now. What he may not know is how proud we are for him instilling this sense of giving back and the belief that one person can, in fact, make a difference. Coincidentally, and rather unfortunately, our oldest brother, Chris, cannot be here today because he is currently traveling with Living Water International and actively keeping his father's legacy alive.
Thank you, Sean. I am Tim Winter, Winter Boy number 2. So we're not. I currently find myself in a very fortunate time of life where I'm both father and son. As a father, I know that the greatest joys that I currently experience are those in celebrations of the acknowledgments of my children. Although they are 7, 5, and 1, they still have had, amazingly enough, some accomplishments to celebrate. As Patrick mentions, at times were very few and far between, and our father, our number 1 fan, was not there to be the first to say, congratulations, great job, job well done, in our exploits. It was a true reward for always, as many say, hey, go make your dad proud. As a child, though, we often fail to return the favor. We're often lost in the endeavors of growing up, and a father's accomplishments become commonplace. Whether it be the roof over our head, food on the table, they become expected. While they certainly are acknowledged, most of these accomplishments are rarely celebrated. As we get to the elder years of our childhood, I know I speak for all my brothers and my mom in saying, congratulations, Dad. This is quite an accomplishment, quite an achievement, a capstone on all the work you have done here at the American Land Title Association, and I feel that we should celebrate it. Dad, you have made your children proud. To the American Land Title Association, you have a president that holds vision. He is passionate, emotional about his work. He is hardworking, committed, dedicated, and disciplined. I know that he will bring everything he has to the many challenges and needs in the coming years of this association. Members, stand easy. The watch has been assumed. My father and your president, Mark Winter.
Well, I think we've all learned a lesson. I bring my own fan club with me wherever I go. Thank you very much. I appreciate those remarks. It's heartfelt. Well, good morning. I just have to catch my breath after all that. And see, I've been hitting the noggin so often playing football that every now and then. But I'd like to open my remarks with a vision statement. And I'd like to talk about the upcoming year, if I may, 2010. In order to talk about the upcoming year, I think we have to reflect what has transpired over the last couple of years. Principally, the economic meltdown and the impact it has had on the housing sector and on the mortgage market. Relative to housing, which many consider the epicenter of this recession, we have seen various reforms introduced that will address the problem. The mortgage market, we have seen many reforms introduced. What I'd like to do is strike that word reform. And I'd like to address change. Similar, for sure. But change, in a way, makes us feel somewhat uneasy. I'm like you. I want tomorrow to look like yesterday. That's not going to happen in this marketplace. Change is a devil we don't know. Also, though, it provides an opportunity, a golden opportunity. Change indicates that there are some moving parts, that things have yet to be solidified, and it gives us a chance to be at that table and to help make some determinations that will enhance our industry. Let me explain. Pending before Congress, and I'll start at the federal level, certainly the RESPA implication. The new RESPA reform will take place January 1st. There'll be many bumps in the night. There's no question about it. But it gives us an opportunity. It gives us an opportunity to strut our stuff, to show that we are the experienced masters of the closing universe. We're going to be looked upon, certainly early on, to help achieve some transparency in the process. That's change. Next, the Consumer Financial Protection Agency, piece of legislation that embraces RESPA, the enforcement and implementation of RESPA. It includes a provision on settlement service providers, and that could lead to some form of federal regulation of those providers. And through the good work, the great effort of ALTA, the credit insurance component, which include title insurance, was deleted from the legislation. That's good, but this agency still is alive and well as it wends its way through Congress, and that'll be changed. Good friend Doug Duncan, Fannie Mae. It's unclear what the future holds for Fannie and Freddie, the future of the GSEs. The administration has indicated that come this spring, they are going to make a recommendation on the type of model that the secondary market should embrace, whether it be a continuation of nationalization, whether it should be a type of public utility, whether it should be a mini May throughout the country, regional Mays. It's unclear. It's unclear. We have to make sure, though, that the one common thread throughout, whatever model is selected, is the continued use of the title insurance product. But it's going to be changed. How do we best address change? And we have an opportunity, a golden opportunity. Nothing's in concrete yet. Many thoughts are under consideration. And may I share with you this vision? It's going to sound simple and basic, and it is. But there's a twist to what I'm about to say. And that's education. I know, you've heard that word before. I know you feel it's a little soft around the edges. But the proposal in Vision 2010 will be a personal type of education, an education with a face, your face. Let me explain. Let's go back a couple of 3 months. Came home at night, turned on the news. What was that lead story? Night after night after night. It's these town hall meetings that members of Congress held back in their districts. Picture what you saw, the emotions, the anger, the finger pointing. In the back of the room, you'd see something in a placard that would read something along the lines of, "Throw the rascals out." Let's fast forward. 2010. It's a congressional election year. Members of Congress, for whatever reason, enjoy being members of Congress. They want to get reelected. And they understood what happened at those town hall meetings. And now they have to woo back that constituency base. They have to win back those hearts and minds of their constituents. May I recommend this? You're a constituent in a district. You have a business in a district. Now is the opportunity to personally educate those policymakers. That's the key. They're the ones that actually vote and decide on our future. May I urge you to contact your district's offices and arrange with your representative a time that they could visit your office, that they could participate at a closing. I'm going to share with you an eyewitness event that I've had in my office, and I've had members of Congress close on homes in the D.C. area. They were engaged in that closing. I'm talking about a member being in the room and absorbing what transpires. Okay. The members here and now are anxious, as I mentioned, to get reelected. They're at the ready to be responsive to their constituent base, now more than ever. When they participate in a closing, it's the most personalized form of education. They begin to appreciate your expertise, your experience, that you're quarterbacking that effort at that settlement table. They begin to understand the role you play on behalf of the consumers. By definition, I mean the purchaser and the seller. And beyond that, and only can they absorb this in person, is the fact that when those constituents, or when those consumers, enter that closing room, they are fearful. There's an element of stress and anxiety. You know it all too well. You see it day after day after day. And because of your expertise, because of your leadership, that dissipates. It goes poof in the night. And all I'm saying is that policymaker will take that away and fully appreciate the value of the title insurance industry. Now, in addition to contacting the policymakers at the federal level, let's take a look at what's transpiring at the state level. Before I came down this morning, I reviewed the states that have some form of title insurance issues that they're considering. I have the number 9, could be 8, could be 10. Dealing with reports, dealing with commissions, dealing with hearings, dealing with information gathering, rate filings, competition, profitability of the industry, commission splits. It goes on and on and on. We have established a program, a personalized education program called Title 101. And in fact, the ranking member of the faculty is here, Anna Anastasia, and I want to congratulate you for your efforts in developing this program. Title 101 does a variety of things. It educates the state policymakers, the NAIC members, other insurance commissioners, professional staff, commission members. It educates them on a personal basis where they fully appreciate the function of a title search and examination, where they can set up a mock settlement so that these policymakers understand what we do and they can answer any and all questions. And working with Ann and the Education Committee, I propose that we not only continue this fine effort, but that we expand it, that we form additional, I'll call them SWAT teams, that are at the ready, that when we at ALTA hear from a state association, we'll always be working in conjunction with the state association, that we can respond quickly, promptly. I've learned over the years that in order to win over hearts and minds, you have to react early. You can't let it go to seed. So I propose a personalized education initiative to address both state and federal level decision makers to help us mold and shape the reform initiatives that will be taking place next year. It's going to enhance the role of our industry. So a challenge. please call your congressman, congresswoman's district office. It's simple. One call. If there's a pushback for any reason, contact ALTA. They know Capitol Hill. They know the members of the House and the Senate. And from that end, they'll be able to help organize and structure such a meeting. Second, I'd like to briefly discuss membership. Looking out at this fine audience, in my heart and mind, and I think in the board's heart and mind also, you're the leaders of the industry, period. You took time out of your busy schedules to join us. You're committed. You're active. You're the leaders. With that leadership role, I'm going to call on you to do one thing, the second challenge. I would like you to sponsor one new member for ALTA membership. I'd like you to go back to your towns, to your cities. I'm sure you know a title professional, an abstractor, a title agent that is not a member of ALTA. Please approach them. We have the momentum that Mike has provided. We're well underway. But in addition, 2010 is a pivotal year for our industry. And finally, I just want to mention TIPAC. TIPAC, in my mind, is the fuel that runs the engine, our education engine, makes it purr. And if we increase our membership, we have more foot soldiers. More foot soldiers, more policymakers are visited. More success to our personalized education program. Where's John Vaso? Is he here? Counting his money. Good. John, it's 12:08. Ring up that cash register. Where are we with type? 222. So, wow. Our goal by the end of the year is 250. We can do that. Our goal in the next minute is 225. We can do that, can't we? Very good. Well, it's an honor and a privilege to serve you. And I would like to thank the past presidents of the association for sharing their moral compass. I would like to thank my board colleagues for sharing their wisdom. And I would like to thank you, the leaders of the association, for sharing your confidence. The Winter family is honored, and I am most humbled. God bless, and thank you.
I think it's safe to say that this trade association is in fine hands going forward. That as good as this convention was, as much as we did this past year, the bar will be set higher next year. I know Mark's going to deliver on that. You know your staff's committed to delivering on that. A couple of announcements before I let you go. The golf winners yesterday, the professional foursome of Kovaleski, Yeager, Willison, and Kovaleski, scored what I think may be a course record of 55. Yeah, we were really close. Liars. Please see John Vaso. We had another winner of the early bird drawing, which is a free registration to the 2010 annual convention in San Diego next year. And that's Alma Rushing. Congratulations. We've got another TIPAC event going on this afternoon, because Vaso never, ever quits. It's a croquet tournament. You'll notice that John has managed to outfit himself with mallets to get the money this time. Very clever, John. We'll also be running a silent auction at the dinner tonight. John managed to procure both a signed copy of The Mystery of Capital by Hernando de Soto and de Soto's Apple. Is it there? Ah, way in back. So how did he do this? Ladies and gentlemen, I want to tell you know, this is de Soto's Apple, and it's going to be good for at least a few more days, and it is signed. The opening bids will start at $250 for the signed copy and for de Soto's Apple. All right. Malcolm Morris is the first. I can recognize your voice without even seeing you. It's the first 250. I hope it goes up quickly from there. But see Mr. Vaso, and I'm sure there'll be a sign-up sheet, and you'll announce the winner later this evening. The closing event is just a celebration event. It's the Flagler Follies. We've got a dinner. I promise no more speeches. And we've got a great floor show for this evening that's in keeping with the majestic architecture of this place. I hope you enjoy it. Thank you for attending. There is no other business before this membership today. And so this concludes the business portion of our session. God bless you. God bless ALTA. God bless America.